is there sort of a tipping point that we're seeing in markets where suddenly it doesn't matter if yields are rising for good reasons or for bad reasons? It is putative given how far valuations have gotten extended.
Yeah, I think that's absolutely right. Look, in the end, equities are a function of growth and also the cost of capital. And the cost of capital is influenced, of course, by short and long-term interest rates. What we've seen in the last 20 years, and particularly since the financial crisis, is this persistent sort of positive correlation between equity prices and bond yields. And that's been an environment which has been very fertile for multi-asset funds. Equities and bonds have been a good hedge against each other, but generally interest rates have trended lower, pushing up the valuation of asset classes. That correlation has shifted. We're now at a level of bond yields where rising yields from here are really going to weigh on all asset classes. And so we find the impact of rising bond yields on equities as being a function of the level, and now we're at the sort of levels where it begins to matter, but also importantly in the speed of adjustment. The faster any rise in yields, the bigger the impact on equities. And what we are seeing is reasonably quick rises again in the very recent past. And I think given the valuation of equities, this is going to be a sort of steep speed bump, as you say. I think the other thing that's very important to emphasize is that it wasn't that long ago, 3-4 years, when about a quarter of all government debt around the world actually had a negative yield. Investors were really paying for the privilege of lending money to governments. That's changed dramatically. And governments around the world, including the US, are seeing deficits rising. And that is likely to spill over into term premia and into stickier, higher, longer-term interest rates, which, of course, affects all asset classes ultimately.